Deflation averted for now as consumer and producer prices recover in July, signal strong third quarter. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit the subscribe button. Today we're going to be talking about what's happening with producer and consumer prices. They've recovered dramatically, coupled with 10 million jobs produced in the past 3 months. The U.S. economy is rapidly recovering from the COVID-19 pandemic, where people were locked up in their homes for a few months. Now they're returning to work, and gasoline prices and oil prices are recovering, and this signals that we're going to get back to a somewhat inflationary, normal course baseline environment in terms of prices. And this is actually a very strong indicator for the third economic quarter that we are entering into after what can only be called a dismal second quarter, where the U.S. economy, GDP, gross domestic product, contracted by 32.9%. Now the third quarter is looking like gangbusters. It's probably going to be the best economic quarter in U.S. history. And that report's going to be coming out right before the election, and it probably portends very well to President Trump's election. So these numbers are certainly welcome news after what was terrible numbers on prices for producers and for consumers in terms of the prices going down. Now, to contextualize this, deflation is when the general price environment is going down, and basically you produce a good, it costs X amount of dollars, and then the price you're going to sell it for is X minus whatever the deflation is. And that usually results in businesses losing money, postponing purchases by consumers who are going to say, well, the good is going to be cheaper tomorrow than it was today. And this creates a vicious cycle that was endemic during the Great Depression. So you never want to see deflation for a prolonged period of time where prices are generally falling, because it seizes up business activity. It strongly correlates with very high unemployment and can be just an economic catastrophe if it goes on for years and years like it did in the Depression. Also in the financial crisis and Great Recession, you were confronted with deflationary conditions that were only averted years later, where it took over 5 years to recover 8 million jobs that were lost in the financial crisis and Great Recession. Conversely, under the COVID-19 pandemic, although 25 million jobs were lost on the front end, in just 3 short months, we've recovered 10 million jobs. Again, it took 5 years to recover 8 million jobs in the Obama economy, and it only took 3 months to recover 10 million in the Trump economy. So let's take a look at some of these numbers where producer prices and consumer prices are growing each 0.6% amid increased demand for oil and gasoline, according to the Bureau of Labor Statistics. And again, the numbers in the early months of 2020 were quite dismal on producer prices. It was down 0.5% in February, down 0.4% in March, down 0.9% in April. It recovered slightly in May, it's plus 0.4%, but then down again in June at 0.2%. And then finally in July, up 0.6%. On the consumer price side of the equation, a similar story is shown here, where in March, prices were down 0.4%, in April down 0.8%, in May down 0.1%, and then finally in June and July, each consecutively up 0.6%, and July up 0.6%. So this shows that the economy is recovering just as the American people are getting back to work. And basically, we've created 10 million jobs. At the low end in April, we were at 133.4 million Americans employed. Now we're at 143.5 million Americans employed. And you can see very clearly here a V-shaped recovery that is forming right now. Now, as for the prices, the reason this was happening, again, a big chunk of your consumer prices and producer prices come out of energy. And so 1/3 of the producer price jump and 1/4 of the consumer price increase comes from increased gasoline consumption and higher fuel prices, relatively higher fuel prices. In April, the oil prices crashed into negative territory, and basically producers had to pay distributors to take the oil off of their hands so that you didn't gum up the works in terms of production, and inventories were dramatically increasing in the early months of 2020. Now those numbers are starting to come on down the past few weeks. They've gone from 518 million the week of July 31st down to 514 million. These are weekly stocks, and usually they go into the mid 400 million range, and they're now down to, they were as high as 540 million crude oil inventories, and now that barrels, and that's down to 514. So clearly those numbers are going in the right direction, and oil prices are correcting as well. Now they were as low as zero in April, and then they got up to $42.55 on today's trading. And so that's just a massive recovery in prices, and that's going to portend well for the third quarter. That means that, the economy is recovering and we're getting back to work. It's good news. And so after a second quarter that set a record on the downside as GDP contracted 32.9%, the rebound in both producer prices and consumer prices, which also grew 0.6% in June, coupled with the job gains, again, 10 million jobs produced in the past 3 months, promises that the third quarter will probably set a record on the upside. And now further fueling the recovery is the U.S. dollar index is correcting quite nicely. This is the trade-weighted U.S. dollar index, broad goods and services. And what it measures is the value of the dollar relative to our trade partners' currencies. And the dollar had been really strong. And this happens during recessions where the dollar is going to get really strong amid a flight to safety as everyone's purchasing U.S. treasuries, financial institutions, central banks. They flood into U.S. treasuries markets, and this makes the dollar relatively stronger. But a strong dollar can lead to deflation, just like a weak dollar can lead to too much inflation. A dollar that is too strong can lead to deflation, and that can crush your economy. Fortunately, the dollar has weakened back to kind of normal levels, particularly in the past several weeks. The highest reading here was almost at 127, 126, and now it's down to 118. And so that's a very good correction. And the way interest rates operate is right now the interest rates are still quite low. The 10-year Treasury is at 0.66%. But what's ended up happening the past month is that the creation of new debt and new treasuries has slowed down dramatically, where according to the U.S. government right now, the national debt is about $26.5 trillion, and it's grown by $3 trillion this year alone, but it's not grown too much in the past month. So at the beginning of the month, it was at 26.5 trillion, and then at the end of June, it was at 26.47 trillion. And so it's not growing that much. The number seems to have stabilized for now. Congress is working on phase 4 legislation, so there'll probably be another increase in national debt the more spending that Congress does. But the point is that the amount of new treasuries that have been created in the next month has almost been non-existent. And this has helped to facilitate the dollar falling because there's less purchases of new treasuries that were driving up the cost of the dollar, making the dollar stronger. Now the dollar is getting slightly weaker as the national debt situation cools off. Again, for now, Congress is still in session, so anything can happen there. Now, when interest rates, including treasuries, remain low, the rate of new treasuries creation has slowed the pace of purchases. Again, it only grew by 0.01% in July after skyrocketing 2.8% in June and 3.1% in May. And that's according to the U.S. Treasury data. Again, the number is now stabilized, though, for now at 26.5 trillion. Obviously, the driving factor here are the number of COVID-19 cases. The IHME, Institute for Health Metrics and Evaluation, it says that the virus peaked in about late March at about 253,000 new cases per day. Now we're down, way down from that, about half to about 127,000 new cases per day. And so fortunately, the amount of deaths is also being kind of cut in half right now. And the worst of the virus is past us for now. And according to the IHME, we're going to see these numbers be kind of stable. They chart 3 scenarios, one with mandates easing, the other is the current projection, and then finally universal masks. So you're not going to be completely mandates eased, and you're not going to completely have universal masks. And so they project that as you hit the cold and flu season in September and October, you're going to see these numbers start climbing again into the winter months, which is what happens every cold and flu season, is you're going to transmit more influenza and more coronaviruses. We're obviously dealing with the coronavirus here, the Chinese coronavirus. And when those numbers start going up again, you might expect to see, kind of the economy go in the opposite direction. But for now, in August and September and October, while these numbers are somewhat stable, according to the projections, then I expect that, the job creation is going to continue. Consumer and producer prices are going to be kind of slightly on the positive side. And this is going to portend very well for the third quarter and maybe even the fourth quarter as well. Now, politically, undoubtedly, that's good news for President Donald Trump. He was the one who was predicting a rapid recovery, and it turns out he was right. We've produced 10 million jobs in pretty rapid succession in the past 3 months. And, he's probably the only one that really saw that coming because he has such high confidence in the U.S. economy. The economy was really strong. And we had record number of people working, record low, 50-year low in unemployment, and all-time high in terms of the amount of people who had jobs. And now those jobs are coming back very, very rapidly. And it was President Trump who predicted that was going to happen. He was right. President Trump probably knows more about the economy than many of the people who look at it. I was worried that this recession would go on for years. It took 5 years to recover from the financial crisis and Great Recession. Once you hit the labor market low in December 2009, you didn't get those 8 million jobs back until 2014. So that was 5 years later. Fortunately, we've produced 10 million jobs in very rapid succession in the past 3 months. And that's going to, again, portend very well for President Trump's re-election. He predicted a rapid recovery, and very much a rapid recovery is still happening. But it's a delicate situation. Looking into the fall, when the cold and flu season returns, IHME is projecting daily new cases will really begin rising in October and November and continue into the winter months. If an effective vaccine or cure is not available by then, I would anticipate that, especially states, if they can't find a way to safely reopen, then what's going to happen again is that states are going to start locking up shop. People are going to start being in their homes again, and then you're going to lose jobs again, and then prices might start falling again. And so this will in turn renew a contraction in labor markets, and then the reactive counter-cyclical congressional spending cycle will, kick up again. They're going to start spending money out the wazoo. The dollar could start strengthening again as markets flood into U.S. treasuries, and this kind of creates that vicious cycle possibility again. So we really should hope that there's either a vaccine or a cure or something that can mitigate the damage that the virus, particularly in those winter months, is going to wreak upon the economy when the virus kicks up again. A lot depends, especially as the autumn wears on whether schools and state economies can return to some semblance of normalcy, or if we're in for another several months behind closed doors. And I'll leave you with the close here. For now, though, the data on both prices and job creation rebounding strongly shows that a classic V-shaped recovery economically is fully underway. The only thing that might stop it now is the virus. Stay tuned. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.